Colonoscopy with a none and confusion about fixed costs. This is Ken Boyd, and this is the Accounting Accidentally Substack page. So getting a colonoscopy is easy. It's the prep the day before that's hard, as you know, if you've ever had one. And let's just say that the prep clears the way for the procedure and we'll move on. It's pretty unpleasant. So if you can imagine this, I'm hooked up to a bed, hooked up in bed to an IV, watching TikTok videos on my phone because the doctor is running late on the procedure. Nurses are sitting at desks on one side of the room. The beds are on the other side, separated by curtains. And one of the nurses says, "Sister Margaret, I'll call Sister Ruth and tell her you're ready to go." Sure enough, Sister Margaret walks up to the nurse's desk from the bed next to me. She's wearing a scarf around her head and the simple clothes of a religious order. I'm sure you've seen nuns in the nun habit. At that moment, the two other nurses come out of the operating area and walk over to me. "Ready to go?" they ask me. "Sure, now that I've seen a nun, the timing can't get any better." This post covers medical costs, the break-even formula, and why so many people don't account for fixed costs correctly. Managing huge costs. The US spends 17.3 of our gross domestic product on healthcare, which is a staggering amount. Gross domestic product is the sum total of all products and services we produce as a country. And over 17% goes to healthcare. My procedure was an ambulatory surgical center, an ASC, which is a facility for outpatient surgery. I went home an hour after I had the procedure. The cost to start an ASC is $3 to $8 million, and there's millions more to operate the business, as you can imagine. And allocating costs is critical in order to generate a profit. And the problem is often the fixed costs. So to explain the fixed costs, let's start with the break-even formula. So understanding the break-even formula, the break-even formula can be stated in several ways, but the most common version is this: sales price per unit times units sold, less variable cost per unit times units sold, less fixed costs in total dollars, that's important, and we set the profit equal to 0. So here's an example. Julie owns Sterling Furniture. She's analyzing her break-even point on her dining room table product line. So she sells each table for $500 a unit, variable costs total $380 a unit, and her total fixed cost, total dollars, equal $200,000. So to solve the problem, we're going to assume that X equals the number of units sold to break even. So it's 500X less 380X less the 200,000 fixed costs equals a 0 profit. We do the algebra and we find out that Julie must sell 1,667 units to cover all the costs related to producing dining room tables. Now, she can also change any of the variables in the formula, any of these variables, and calculate break-even based on a new assumption. For example, she could increase the price per unit from 500 to a higher number, and the number of units she'd need to produce would be lower because she'd earn more sales dollars on each unit. So what's the issue with fixed costs? You can see, as I mentioned a couple of times, sales and variable costs are measured per unit, while fixed costs are measured in total dollars. And that distinction is important because once you pay for all fixed costs, they no longer impact the formula. You're all done. You're not paying anymore. So to illustrate, here's the wrong way to think about fixed costs. Let's assume that Sterling assigns fixed costs on a per unit basis, $120 a unit. Well, if Sterling sells 200 units, fixed costs total $240,000. But that's not possible. Once fixed costs hit 200,000, the costs end. They're allocating $440,000 too much in costs that aren't being incurred. And fully covering your fixed costs can also lead to higher profitability. Let's talk about leveraging fixed costs. The more revenue you earn from an asset, the better. The example I've used for years: if a plumber owns a $30,000 truck and he's carrying $10,000 in equipment on the truck, it's a $40,000 investment. If he works on 200 plumbing jobs a year, he gets more out of his investment in terms of sales and earnings than if he only works 150 jobs a year. So more work with the same fixed asset. Special orders also explain the benefits of fully covering fixed costs. So let's assume that Sterling Furniture gets a call from a customer in the last few weeks of the year. The customer asks Julie for a quote on a furniture order. The question is, What are Julie's costs for the order? At this point in the year, fixed costs have already been covered with prior sales. So Sterling's only cost is the variable cost of $380 a unit. There is no additional costs incurred for more fixed costs. Julie does not incur fixed costs to fulfill the order. It's possible that she could price the item she's going to sell at less than $500 a unit and still make a profit because that $200,000 in fixed costs is all paid for. So what's the lesson here? When you use the break-even formula, use fixed costs in total dollars, not per unit. Fixed costs may not be incurred for every unit produced or sold. They end at some point. So that was the lesson here. And remember that you can find other great accounting and finance content, Accounting Accidentally, at substack.com.